Welcome back to the deep dive. So you've decided you want to start investing. You read all the headlines, right? Compounding interest, long-term growth, the power of index funds. It sounds pretty simple. Buy low, hold for a few decades, retire comfortably. But then you get the prospectus. And suddenly you're just drowning in jargon. CDSC, 12B1, expense ratios, breakpoints. It's like 100 pages of acronyms and percentages that well, it feels like it's designed to confuse you.
It absolutely does. And that confusion, that's exactly where the industry profits. Investing is, at its core, a simple concept. But mutual fund fees are anything but. Today, we're diving deep into those hidden costs, the charges that don't look like much on paper, maybe, just a fraction of a percent, but they silently, relentlessly erode your long-term returns year after year.
And we have dissected a phenomenal source document for this. It's like a genuine taxonomy of every single charge, fee, and expense a mutual fund investor could possibly encounter. It covers everything from that upfront sales commission to the operational friction deep inside the fund's trading desk.
And our mission here for you is to not just read these definitions out loud. We want to truly map this financial landscape. We're building a clear, structured guide to all of these fees. By the time we finish this deep dive, you will understand the underlying purpose of every single charge. And that really is the only way to effectively compare funds and pick the best path for your capital.
Okay, so let's frame the core problem right away. I mean, running a successful mutual fund, it's a complex business. They need top-tier investment talent, admin staff, legal, trading infrastructure, marketing. These are significant costs and, well, they have to be paid.
Right. And they get passed directly to us, the investors, in two main buckets. First, you have the direct shareholder fees. These are charged when you buy or sell shares. And second, you have the indirect operating expenses. These are the percentage fees that are paid constantly right out of the fund's total assets.
And that indirect stream of payments, that's the real focus, isn't it? Because that's the stealth killer of returns.
It absolutely is. We might look at a 1.5% annual fee and think, oh, it's only 1.5%. But when you hold an investment for 30 or 40 years, the compounding effect of that fee, just eating away at your potential gains year after year, it can reduce your final earnings by tens or even hundreds of thousands of dollars. This is why we always emphasize moving beyond the surface level claims and really calculating the total expense ratio, or a TER. And then you have to compare it ruthlessly against the industry benchmarks.
And when you look at those benchmarks, the initial data we pulled from 2020 on U.S. funds is incredibly stark. It just immediately highlights the economic question. What are you actually getting for paying those extra percentage points?
We have the weighted average total expense ratios for all U.S. funds as of December 31st, 2020. And the difference between active and passive management. It's a profound knowledge nugget right out of the gate. Across all funds, the weighted average TER for all active funds was a staggering 1.04%.
Over 1%, just for a human to try to beat the market?
Exactly. Now, compare that to all passive or index funds. Their weighted average TER was a remarkably low 0.45%. That's a cost difference of nearly 60 basis points right away.
Wait, I have to challenge that just for a second. An active management advocate would say, well, that 1.04% fee is totally justified if my manager delivers an extra 2% return, netting me 10% instead of 8%. Do investors actually tolerate this huge gap?
We do. They tolerate it based on hope. And on the historical reality that while most active managers do underperform, the possibility that you'll pick that one outlier who consistently wins, well, that's enough to keep the money flowing. But the trend is clear. The market is moving toward passive, largely because of data like this. And look at specific asset classes where the margin is even thinner. Taxable bond funds. Active averaged 0.85% versus passive at a breathtakingly low 0.23%. In a low-return world like fixed income, paying that extra fee means you're consuming a much, much larger chunk of your gross return.
That data right there confirms that chasing low costs isn't just about saving a few bucks. It's about maximizing the efficiency of your capital. Okay, let's unpack the specifics then. We'll start with the upfront, direct charges. The fees that are levied directly against you when you move money in or out. These are the transactional fees paid to the fund.
Right. Think of these as the administrative costs, and they're distinct from sales commissions. They're like the toll booths you hit on the investment highway.
First up, we have the purchase fee charged when you buy shares. Why is the distinction between this and a front-end sales load so important?
That distinction is critical, and it really goes to the regulatory framework. A front-end load, which we'll get to, is a commission paid to the broker who sold you the fund. A purchase fee is paid directly to the fund itself. Its purpose is purely administrative. It's there to defray the fund's internal costs associated with your purchase. It's not for sales advice.
So if I put $10,000 into a fund, a 1% purchase fee means the fund keeps $100 to cover paperwork, whereas a 1% front-end load means the broker keeps $100 for selling it to me.
Precisely. The purchase fee is about the mechanical cost of integrating your money. And, conceptually, it can also act as a sort of minor protection for existing shareholders. It ensures that new money coming in pays its own way and doesn't dilute the interests of people already holding shares.
Then we have the mirror image, the redemption fee. This is charged when you sell or redeem shares.
And this is a fee paid directly to the fund when you pull your money out. Again, this is not the broker's commission. That would be a deferred sales load.
Yeah.
The redemption fee is designed to defray the fund's costs associated with liquidating assets to meet your redemption request.
But the redemption fee often serves a second, maybe unstated purpose, doesn't it?
Absolutely. It's a mechanism to deter short-term trading. If an investor is constantly buying and selling, trying to time the market, that activity can force the fund manager to make unnecessary trades. And that raises costs and disrupts the strategy for all the long-term holders. So by imposing a redemption fee, especially one that expires after, say, 60 days, the fund discourages that disruptive behavior.
That suddenly makes the fee seem beneficial rather than punitive if you're a long-term holder.
It's all about aligning interests.
Okay, finally in this category, we have the very specific exchange fee.
Right. This is the fee you pay if you transfer shares to another fund within the same family of funds. So let's say you hold the Sterling Large Cap Growth Fund, and you decide you want to move that capital to the Sterling International Bond Fund. You're staying with the same company, but you're making them process a full sale and a full purchase internally.
Is that really always necessary? I mean, they already have my money. Why the extra charge?
It's a processing fee. The complexity of transferring assets, updating shareholder records, and, potentially liquidating assets in the first fund and acquiring them in the second. It just warrants a small administrative charge. It's their way of recouping the labor involved.
So purchase, redemption, and exchange fees. That's our first bucket. Transactional costs paid directly to the fund for the mechanics of moving money.
Exactly. One-time hits for specific actions.
So that covers the one-time hit. But what about what happens every single day the fund is operating? The engine still needs fuel, maintenance, marketing. If those direct fees are the toll booths, these periodic operating expenses are like the fund's ongoing utilities bill. It's paid constantly, automatically from the fund's assets. This is that persistent, invisible draw on your capital.
So what exactly are these ongoing costs covering that justifies paying them 365 days a year?
Well, we start with the most essential and usually the largest component, the management fee.
The heavyweight champion. Indeed. This fee is paid out of the fund's assets to the fund's investment advisor. This is a big one because it covers the core function, portfolio management, the salaries for the fund manager, the research analysts, the strategists, the team doing the intense work of picking stocks and bonds.
And it's not just the investment decisions, is it?
Correct. The management fee often bundles in other general management or administrative fees. Our source notes they're also sometimes called maintenance fees. It's sort of a catch-all for the intellectual property and the administrative oversight that the advisory firm provides.
And if a fund is huge, say $10 billion in assets under management, and it charges a 1% management fee, that's $100 million in fees a year. That is a substantial piece of business.
It shows you the scale, and that management fee is the primary reason for the price difference between active and passive funds. Passive funds don't need a team of expensive analysts trying to beat the S&P 500. They just need algorithms to replicate it.
Okay, moving on. We have the specific account fee. This is separately imposed on investors for account maintenance.
And this is a point of concern for new or smaller investors. The source material really emphasizes that some funds impose this fee specifically on accounts whose value is less than a certain dollar amount.
That seems counterproductive. You're penalizing the exact people you want to encourage to start saving.
It's purely economic for the fund. If they figure that the administrative cost of maintaining, say, a sub-$2,000 account is disproportionately high relative to the tiny management fee they collect on it, they impose this account fee to cover their overhead. So if your balance dips below their threshold, you get hit with a specific annual charge just for holding a small balance.
Now let's move to one of the most famous and, frankly, historically controversial fees, distribution and service fees, known everywhere as the 12b-1 rule.
named after Section 12 of the Investment Company Act of 1940. This fee is basically the fund's marketing budget, and it's paid for by your investment dollars. These fees are explicitly paid by the fund, out of fund assets, to cover the costs of marketing, selling shares, and providing shareholder services.
Let's break down those two components, distribution versus service.
So distribution fees are the costs of bringing in new money. This is the compensation for brokers and financial intermediaries who sell the fund shares. It covers advertising, printing, and mailing prospectuses to new investors. All the sales literature. It's the cost of growth.
And the shareholder service fees part.
That covers the ongoing support. The people who answer investor questions, handle address changes, and provide information. This is the cost of maintaining the relationship. And a crucial point from the source. These servicing fees can be paid either inside or outside of a Rule 12b-1 plan, meaning they might be hidden in that other expenses bucket.
And here it is, the classic aha moment that trips up every new investor, the no-load loophole. How can a fund that charges a 12b-1 fee still call itself no-load?
It's a regulatory definition game. The term load strictly refers to the sales commission paid to the broker. Funds can charge up to 0.25% of fund assets annually in these distribution fees and still legally describe themselves as no load. That 25 basis points is a persistent annual fee for distribution, yet the fund gets to advertise zero upfront sales cost.
So on $10,000, that's $25 a year. It doesn't sound like much. But over 30 years, that $25 compounding annually is not trivial. And it confirms that no load is a marketing term. It's not a statement of zero cost.
It's a statement of zero sales commission. The fund is still paying for marketing, and you're paying for it through a continuous small percentage reduction in your capital. It's a critical distinction.
And that moves us to the really shadowy category in operating expenses, other operating expenses, specifically the transaction costs.
This is where it gets really interesting, because this cost is invisible to the casual investor. Yet it's often a significant drag on performance, especially for actively managed funds. Transaction costs are the actual expenses the fund incurs when it buys and sells its underlying assets. So brokerage commissions, exchange fees, bid-ask spreads, settlement costs.
Why do these costs vary so much between different funds?
They're driven by two key internal decisions. First, the fund's turnover ratio. This measures how frequently a fund replaces its holdings. A 100% turnover ratio means the manager, on average, sold and replaced the entire portfolio over the year. High turnover funds generate massive trading friction.
What's considered a high turnover?
Generally, anything over 100% is very high. Index funds, by contrast, might have turnover ratios well below 10%. The difference is just night and day.
And the second factor?
The type of market the fund trades in. If a fund is investing in highly liquid, major market stocks like the S&P 500, transaction costs are low. But if they're investing in illiquid, emerging, or exotic markets, say small cap stocks in Vietnam, the cost of entry and exit will be significantly higher.
Okay, here's the core technical nugget that everyone needs to remember. Unlike the management fee or the 12b-1 fee, which are all rolled up into the total expense ratio, these transaction costs are usually not reported directly to the investor.
Correct. This is a regulatory loophole that frustrates a lot of industry analysts. The TR captures advisory, admin, and distribution costs. But the trading friction, the cost of moving assets around, it's not required to be itemized and reported. Instead, that cost is just absorbed by the fund and reflected in a slightly lower net asset value, or NAV, every single day.
It's an invisible tax on performance. How can we estimate it? Give us a hypothetical.
So if you invest $10,000 in an actively managed fund with a 100% turnover ratio, you might implicitly incur an extra 0.5%, maybe 1%, in hidden transaction costs every year. That 0.5%, $50 a year on 10 grand, is a cost you never see itemized. But it's paid.
So if I'm comparing two active funds, Fund A has a T of 1% with 10% turnover. Fund B has a TR of 1% with 150% turnover. I should mentally realize that Fund B's true cost is probably closer to 1.5 or 2%.
Absolutely. High turnover in an active fund is a massive red flag that demands a deeper look.
Okay. We've covered fees paid to the fund and fees paid from the fund's assets. Now we get to the third big bucket, the loads. This is where the money goes to the intermediary. It's the sales commission.
This is the commission structure that really defines the different share classes, A, B, and C. A sales load is a percentage charge on the purchase or sale of shares. It's the commission paid to the broker who put you into the fund.
Let's start with the most traditional structure. The front-end load, which is the hallmark of Class A shares.
This is also known as a sales charge. It's a fee paid right when you purchase the shares. And as we established, it goes straight to the brokers. The key impact on your investment is immediate and substantial.
It's not just a charge, it reduces your starting capital.
Exactly. Let's use that classic example. You bring $10,000 to invest in a fund with a 5% front-end load. The brokerage firm immediately takes $500 as their commission. Only $9,500 is actually invested in the market.
So that $9,500 has to gain over 5% just to get you back to your starting 10 grand. You start the race behind the starting line.
That's the psychological friction. Your money is immediately playing catch-up just to break even on the commission. The one advantage, though, is that once you pay that upfront load, the annual operating expenses for Class A shares, including the 12B1 fees, tend to be the lowest of all the share classes.
And there are legal limits on this initial hit, right?
Yes, though they are rarely tested these days. Under the Investment Company Act of 1940, the max is 9%. Under FINIRA rules, it's capped at 8.5%. High numbers, but they set the legal boundary.
All right, moving on to the back-end load, which is typically associated with Class B shares.
This one is known as a Contingent Deferred Sales Charge, or CDSC. As the name says, it's a fee paid when shares are sold, hence batch end. It still typically goes to the stockbrokers who sold the fund.
Why would a broker agree to defer their commission?
Because the fund compensates them upfront anyway. It advances the commission, then collects it over time through higher annual 12B1 fees from the investor, backed by the promise of that CDSC if the investor leaves early. The whole structure is designed for long-term retention.
So if I buy Class B shares, I pay no upfront commission, but I'm implicitly locked into a holding period.
Think of it like a free cell phone deal where you're locked into a 7-year service contract with a huge early termination fee. The CDSC starts high, often 5 or 6% in the first year. But here's the key feature. The fee incrementally discounts for each year you hold the shares. After maybe 5, 6, or 7 years, the fee usually decreases to 0. And that schedule has to be clearly disclosed in the prospectus.
So if I sell in year 1, I pay the full 6%. If I sell in year 8, I pay nothing. It's a stick to keep you invested.
Exactly. It smooths the compensation for the broker and protects the fund from having to liquidate assets prematurely.
Okay, next, the hybrid. The level load or low load.
This is sometimes associated with Class C shares, but it's a bit different. Like back-end loads, no charge is paid when buying. If a back-end load is charged when you sell, the time frame is significantly shorter than a standard CDSC, maybe just 1 or 2 years. It's less of a 7-year commitment and more of a short-term deterrent.
And finally, the structure that causes the most confusion because of marketing, the no-load fund.
Associated primarily with Class C shares. A no-load fund does not charge any type of sales load. No upfront commission, maybe a very small, short-term back-end charge, or none at all. But this is the big aha moment we need to really drive home. Not every fee is a sales load.
So what's the trade-off for zero commission?
The trade-off is simple: high annual fees. While a no-load fund can still charge those administrative transaction fees, purchase, redemption, exchange, the core issue is that Class C shares generally have the highest annual expense charges of all share classes. The ongoing 12B1 fee and other administrative expenses are structured higher to perpetually compensate the brokers who sold them.
So Class A hits you hard once but runs cheaply forever. Class C lets you in for free but charges you a little bit every single day.
Precisely. If you are a short-term investor, Class C might look attractive. But for someone holding the fund for 10 or more years, the cumulative cost of that higher annual expense ratio in Class C will almost certainly exceed the initial load you would have paid on Class A shares. The cost doesn't vanish, it just changes form.
That is a critical piece of synthesis. The cost doesn't vanish, it just changes form.
Changes the psychology, but the economics are relentless.
Okay, now let's shift gears. We've defined the taxonomy. Now we connect this to the bigger picture, looking at the regulatory and structural details unique to the U.S. market. Let's start by drilling down on Class A shares and the volume discounts available, breakpoints.
Breakpoints are essentially volume discounts for fund investors. Funds that charge front-end sales loads often charge lower loads for larger investments. These predefined investment levels are called breakpoints.
It sounds like buying in bulk. Why is this so significant?
It drastically changes the economics of the investment. For instance, a fund might charge a 5% load on investments under $25,000, but only 4% if you invest between $25,000 and $50,000. Recognizing and hitting those breakpoints saves you a huge chunk of capital right at the start.
Is the fund required to offer these?
No. The SEC doesn't mandate that a fund offer breakpoints, but the crucial rule is, if they do exist, the fund must fully and clearly disclose them. The onus is on the investor to know they exist.
And there's a major ethical responsibility tied to the broker here, right?
Absolutely. FINRA is very clear on this. Brokerage firms must not sell shares in an amount that is just below a breakpoint simply to earn a higher commission. It's called a breakpoint violation. It's a breach of fiduciary duty.
So how does an investor who might not have $50,000 all at once make sure they qualify for the lowest possible load? This is the actionable takeaway.
This is where we get into some advanced strategies, which should be in every prospectus. There are two main ways funds help you aggregate your investments to hit breakpoints: rights of accumulation, or ROA, and letters of intent, or LOI.
Explain rights of accumulation.
ROA means that the fund counts the total value of all investments you currently hold with that fund company, often across multiple accounts, including, say, those held by your spouse and children in the same fund family. They look at your current aggregate holding to determine which breakpoint you qualify for on your new investment.
So if I bought $40,000 worth 5 years ago and I'm adding $10,000 today, my $10,000 purchase is treated as a $50,000 purchase for the discount calculation.
Exactly. You are accumulating the right to a lower fee.
And what about the letter of intent, the LOI?
The LOI is a formal, non-binding agreement where you state your intention to invest a certain amount over a specific period, usually 13 months, to qualify for a breakpoint today. For example, you sign an LOI saying you intend to invest $100,000 over the next year. Based on that promise, all your purchases start immediately receiving the discount for the $100,000 level, even if you've only put in $20,000 so far.
That's powerful. What if I failed to meet the target?
The LOI usually has a custodial requirement. Shares are often held in escrow. If you fail to meet the target, the fund may liquidate some of those escrowed shares to recover the difference between the discounted load you paid and the higher load you actually qualified for. So it's flexible, but there are consequences.
The action item is clear. Do not buy Class A shares without asking about ROA and signing an LOI if you plan to invest more over the next year.
That is precisely right. Use the volume discount you've earned or promised to earn.
Okay, now that we have all the components, let's synthesize this into a deeper dive on the share class structure itself.
This comparison is essential. You have to understand which class serves which timeline best.
Let's start again with Class A shares.
Class A imposes the front-end load. Their structure is designed for long-term investors or those making large one-time investments. They have the lowest annual expenses and the lowest 12b-1 fee, meaning the compounding drag of fees is minimized over decades, and their load is reduced via breakpoints.
Next, Class B shares.
Class B operates under the CDSC, or back-end load, structure, zero upfront commission. They impose higher annual 12b-1 fees than Class A to cover the advance commission paid to the broker. The key feature here is the conversion Class B shares might automatically convert to Class A shares after the CDSC period expires, typically 7 to 10 years.
Wait, why would they convert?
Because once that commission period is over, there's no real reason to charge the high 12b-1 fee anymore. By converting to Class A, the investor trades that expensive B structure for the significantly lower annual cost structure of the Class A shareholder. It optimizes the cost for the rest of their investment horizon.
So Class B is essentially a high-cost transition strategy for investors who can't afford the upfront load but are certain they'll hold for at least 7 years.
Precisely. If you're unsure you'll hold it that long, the CDSC is punitive. If you hold it for life, it converts, and you eventually get the low annual cost.
And finally, Class C shares, the no-load option.
Class C shares generally have the highest perpetual annual expenses. They might have a small short-term back-end charge, but their defining feature is that they do not convert to another class. They maintain that high 12b-1 fee and high overall expense ratio indefinitely.
Can you put a dollar value on that difference over 20 years?
Imagine two investors, both with a $50,000 position. Investor A paid a 5% front-end load, $2,500, but pays 0.5% TE annually. Investor C paid zero upfront but pays 1.5% TE annually. After 20 years, assuming an 8% return, Investor C, because of that extra 1% annual drag, will likely have forfeited an amount far, far exceeding that initial $2,500 load. Class C shares are rarely suitable for long-term investing.
And as we move into the regulatory limits, what's the absolute cap on that 12b-1 fee under U.S. rules?
Under FINRA rules, the max annual 12b1 fee is 1%, and that's broken down. A maximum of 0.75% for distribution, which is marketing and sales, and a max of 0.25% for shareholder servicing. No fund can charge you more than 1% of your assets every year for that.
Okay, now we get to the really sophisticated accounting. Let's talk about waivers, reimbursements, and recoupments. This is the fine print investors need to check, especially for newer funds.
This addresses the financial reality of launching a new mutual fund. When a fund is small, its fixed operating costs like rent or audit fees can look enormous as a percentage of total assets. To make the fund look competitive, the advisor might enter into a waiver or reimbursement agreement.
So the advisor temporarily absorbs some of the costs to keep the reported expense ratio low. They eat the cost to attract assets.
Precisely. They temporarily reduce expenses to a predetermined lower level. But here is the critical catch: the recoupment provision.
The moment of repayment.
Sometimes, these waived amounts must be repaid or recouped by the fund later on. This repayment period is often capped, generally not exceeding 3 years from when the original expense was incurred. This means the advisory firm gets to claw back the money it temporarily waived once the fund is big enough to absorb it.
Let's walk through an example, a fictional fund over a few years.
Year 1. The fund is new, $10 million in assets. Actual costs are 1.5%. The advisor weighs 0.6% to meet a 0.9% cap. The advisor just incurred an obligation of $60,000 that the fund now owes back. Year 2. The fund grows to $100 million. The actual expense ratio drops because of scale, but the advisor starts a recoupment process, maybe claiming an extra 0.1% that year. Year 3. The fund keeps growing, but must continue to pay off that year 1 deficit.
But hold on, here's the devastating implication. The fund is repaying costs incurred before I even bought my shares.
That is the astonishing truth. If a recoupment plan is in effect, future shareholders who join in year 3 or 4 may be required to absorb expenses the fund incurred in prior years. You are paying to reimburse the advisor for marketing expenses they waived when the fund was tiny, and it's buried deep in the prospectus.
That is a phenomenal piece of knowledge. You must check the prospectus for any ongoing recoupment obligations. Now let's move to a key mathematical insight, the predictiveness of expenses. Fixed versus variable costs.
This is fundamental. We're always warned that past performance is not predictive of future returns, but here is the inverse truth. Expenses are remarkably predictive. Funds with high expense ratios tend to continue having high expense ratios.
Why is that certainty so high? Why can't a successful fund, once it hits $20 billion in assets, suddenly lower its cost because of efficiency?
Because of how the costs are structured. While funds have some fixed costs, like an office lease or audit fees, the majority of their expenses, especially the largest ones, behave as variable costs in total dollars, but as fixed costs as a percentage of assets.
That sounds contradictory. Walk me through the math.
Let's focus on the management fee. If the advisory contract states a 0.75% management fee, that fee is fixed on a percentage basis. If the fund has $10 million in assets, the fee is $75,000. If the fund grows to $1 billion in assets, the fee automatically becomes $7.5 million. The percentage consumed remains 0.75%, regardless of how large the fund gets.
I get it. A fixed cost like a $100,000 audit fee becomes a negligible percentage of a billion-dollar fund. That efficiency is passed on. But the massive variable cost, the management fee, keeps taking the same percentage bite, completely neutralizing the gains from scale.
Exactly. Since the management fee is locked in as a percentage, and it's the dominant expense, it's extremely difficult for a fund to dramatically lower its expense ratio. If you buy a fund with a 1.2% expense ratio today, you should fully expect it to be 1.2% 10 years from now.
That insight alone changes how you screen investments. The expense ratio is a permanent feature, not a temporary condition waiting to improve.
Treat the TER as the most reliable, unmoving number in the entire prospectus.
Finally, let's tie this math back to your portfolio through the context of the asset class. Expenses matter relative to investment type.
This is the essential so what of the entire deep dive. The acceptability of an expense ratio depends entirely on the historical return potential of the asset class. You have to gauge the cost as a percentage of your expected profit, not just as a percentage of your capital.
We'll use 3 broad categories: equity, bond, and money market funds. Start with equity funds.
Equity funds historically are the highest return category. Let's assume a long-term gross return of 10%. If that fund charges a 1% expense ratio, the fee consumes approximately 10% of your total gross return. While 1% is still high, the massive growth engine softens the blow a bit.
Now bond funds. Lower return potential, usually less volatile.
If the historical gross return for a bond fund is, say, 8%, that same 1% expense ratio now consumes about 12.5% of your return. You're forfeiting an extra 2.5% of your profit just by moving into a slightly lower returning asset class, even though the fee percentage is the same. The damage increases.
And the most dramatic example, money market funds.
They have the lowest historical returns, maybe 5% over time. That 1% expense ratio in this context consumes a massive 20% of your historical total return.
1/5 of your profit just goes to operational fees. That changes everything. You have to be hyper-aggressive about cost control here.
You must. This just reinforces the need to evaluate the fee against the asset class. A 1% fee is dramatically more destructive to a fixed income or money market investor than it is to an equity investor. The lower the expected return, the more imperative it is to pursue the absolute lowest expense ratios you can find.
This deep dive has fully illuminated the dark corners of the prospectus. Let's bring it all back together for a final synthesis.
We reviewed the three main buckets of charges. We started with the immediate direct payments, transaction fees, purchase, redemption, exchange, which goes straight to the fund.
Then we looked at the recurring draw from the fund's assets, the periodic fees. That includes the massive management fees, those punitive account fees for small investors, and the crucial 12B1 fees, which facilitate that no-load marketing claim. And we highlighted that critical hidden expense transaction costs from high portfolio turnover, which aren't in the reported TER.
And finally, we covered the loads front, back, and level. These are the commissions paid to the broker, directly tied to the share class structure of A, B, and C. We saw how the true cost is the total expense ratio, plus hidden transaction costs, plus any upfront commission.
So you now have the tools to understand the why and the how of every mutual fund charge. This empowers you to move from just passively receiving information to actively making a decision. What's the final actionable set of takeaways from all this complexity?
Your power lies in focusing on minimization. You have to ruthlessly focus on minimizing annual expenses, especially in low-return environments like bond funds. If you're considering Class A shares for a large investment, you must investigate breakpoints and use rights of accumulation and letters of intent to get the maximum discount. And critically, be very wary of the high, persistent annual costs of Class C no-load shares. The zero upfront commission is a psychological comfort, but the long-term drag will cost you far more over a multi-decade investing horizon.
Brilliant. And let's leave you with one final provocative thought that builds on what we learned today about the mathematics of cost. We established that a fund's high expense ratio is highly predictable because the majority of those costs, the management fee, are locked in as a constant percentage of assets. If a successful fund grows from $100 million to $10 billion and its advisor's revenue increases 100-fold without them having to dramatically lower the percentage they charge you, what truly forces a fund advisor to aggressively lower the expense ratio once it has established its history and the asset base is large?
That decision to reduce the percentage fee is almost entirely driven by competition, not by any intrinsic operational efficiency that they're mandated to share with you. The incentive to save you money often comes from outside the fund, not from within.
Think about that next time you see a massive fund with a high expense ratio. That's all for this deep dive. We'll see you next time.